In the investment plan section, we want to enter in your investment details. Specifically, we want to enter in your investment fees. If you're not sure about that, you can always ask your investment advisor, or you can look at your statements. We want to enter the MERs for any mutual funds or ETFs, plus any advisor fees that you might be paying. We also enter your asset allocation. So in this case, John and Lisa are in a growth portfolio. So we've got 80% in equities, stocks, and we've got 20% in bonds, fixed income. We've entered their fees here. If you're in a more balanced portfolio, you might enter 60% for stock equities and 40% for bonds, fixed income. If we scroll down, we also have a cash allocation that we can enter as well. Just in case there's some GICs or cash as part of your portfolio, you can enter that here, as long as it's short-term GICs and cash. And then we have our total net return. So this is after fees. Now we do use the FB Canada rate of return assumptions. Every CFP in Canada should be using these for their long-term projections. This might be a little bit lower than the investment returns that you've had over the last 10 years or so. But again, we've been in a long bull market for the last 10 years, knock on wood. And so we're using the FB Canada rate of return assumptions for long-term planning. Now, if you do need to change those for any specific reason, you can do that in the planning projection section in advanced options. So you do have an option to overwrite these with a specific rate of return, but we would recommend for long-term planning that you leave the FB Canada rate of return assumptions. Now for savings accounts, for cash, we're just entering the inflation assumption. So that's around 2% for the platform. So we're just going to leave that there. If you have a checking savings account that has even lower returns, you might enter 0 there or 0.5%. Now this type of return column, this type of return and portfolio turnover, it applies specifically to non-registered investments and to the equity allocation. The reason why this is important is because the type of return matters from a tax perspective. So out of this 4.46% return, the type of return is allocating that between capital gains, eligible dividends, and foreign dividends. So by default, it assumes 60% is coming from capital gains. So 60% of the equity return, 20% of the equity return is coming from Canadian eligible dividends, and 20% from foreign dividends. This is a good assumption for a diversified all-in-one ETF, and that's why we've got those assumptions there, but you can edit them if you've got all of your investments in, for an example, Canadian eligible dividend paying stocks. So you could enter a much higher value for eligible dividends. The portfolio turnover, the reason why that's important is because it might be capital gains distributions from your ETFs, or it might be you rebalancing your portfolio over time. So this just triggers a little bit of capital gains every year to account for those capital gains distributions and or for any rebalancing that you're doing on your portfolio. For the most part, if you don't have a non-registered account, just leave those all as the defaults. Even if you have a non-registered account and you're not entirely sure, leave the defaults for now. It's a very good assumption to get started with.